On this episode of An Acquired Taste, I'll give you the reasons why venture capital feels broken right now. Let's jump in with some interesting data points from the National Venture Capital Association and PitchBook's Venture Monitor report. It's a whole lot of words, but it is a quarterly report that the NVCA and PitchBook put out cooperatively, and it's very interesting and has a ton of good data. There were 4 specific things that I thought were particularly interesting. Number 1, there are more unicorns sitting in private markets right now than ever before. And unicorns being defined as companies that have a valuation of $1 billion or more. Number 2, most of those unicorns haven't raised since 2022. Number 3, 4 artificial intelligence deals, Databricks, OpenAI, xAI, Waymo, and Anthropic, represented 43% of the total deal value in Q4 of 2024. And number 4, 2 of the biggest tech IPOs in 2024, Reddit and ServiceTitan, went public at lower valuations than their previous private market valuations. So why are these 4 data points so important? Let's get into the details one by one. But first, I want to make a few macro statements. When the largest venture-backed companies don't have liquidity events, and what I mean by liquidity events are initial public offerings, merger and acquisition activity, buyouts, etc., the entire asset class starts to slow way down. That means it gets harder for startups and anybody in kind of series or seed stage fundraising to go out and raise that money. Because when investors lack liquidity, they don't have the capital to reinvest. And their current risk tolerance, largely driven by return pressures, right? I need to create returns for my investors, for my LPs, for my stakeholders, that is created from that illiquidity and that tie-up of that capital. So it further discourages them from investing in early-stage startups because they know that early-stage investment represents even more illiquidity for several years. Their money's being tied up at that point, and they'll need to return capital to their LPs, their investors, shareholders, whatever their arrangement is, not as likely to reinvest in early stage startups because of that illiquidity. But let's get back to the more specific data points. So number 1, the reason so many unicorns are sitting in private markets and not progressing into the public markets or into M&A activity is because there is virtually no IPO interest from the market, and maybe more specifically from the investors in those privately held companies. The issue here is those valuations for a lot of those unicorns in the private markets are very high. And when you have a very high valuation in the private markets, it's difficult to see a path forward in the public markets that's going to sustain those valuations, especially if some of those unicorn valuations were set in 2020, 2021, or 2022 when the market was its frothiest. It's also difficult for those unicorns to raise more money privately outside of public money or outside of M&A activity because investors will look at it and say, that's the top of the valuation. I can't get a markup on my private investment on a company that's already valued at a couple $2 billion. It doesn't help that there were a spate of broken IPOs in 2022 and 2023, meaning that companies started trading their publicly available stock at lower valuations than their previous private market valuations. So the motivation for these companies that have these high private valuations to go public is very limited. And their investors don't necessarily want them to do it because their investors could lose money or certainly see a lower valuation than even when they bought in several years ago. Number two, unicorn fundraising has dried up, as I said before. The previous valuations assigned to those companies were so high that investors don't see any upside left. Number three, AI continues to take the lion's share of all fundraising. And that's happening for a combination of reasons. One is FOMO, or fear of missing out, kind of an overly frothy market around AI, some irrational exuberance, to quote Warren Buffett. And there's also a huge amount of concentration around venture capital into fewer and fewer funds. Those funds are what you would call mega funds, $500 billion funds, $200 billion funds, heck, for that matter, $100 billion funds. Those are the folks that are playing most of the role in some of these biggest AI deals. So think OpenAI, think XAI, think some of these other kind of name brand AI companies and fundraising. That concentration will further weed out opportunities for seed stage investing, smaller AI companies, other even fund managers trying to raise money to invest in companies that aren't these mega AI companies. Now, with DeepSeek's announcement around their pricing and cost structure, we may actually see a momentary reset of that dynamic, because that investing in those US-based AI startups at those massive valuations, it could get a little bit reset, let's say. I don't think the private market valuations of OpenAI, for example, are going to crater, but it could be a little bit interesting around how their valuations are perceived by new investors and current investors, given that DeepSeek has come out with something that's effectively 27 times cheaper. And then there will be some correlation potentially around valuations of other companies, whether it's NVIDIA or other AI hardware providers, people that are in the space. Maybe they're not the AI company themselves, but they provide the hardware, the GPUs, etc. So why should anyone care about IPOs drying up? I assume if you're watching this podcast, maybe you're a startup founder, you're an early stage startup employee, maybe you're an investor. So why should it matter that these IPOs are drying up when the largest companies with significant investment dollars poured into them don't go public or get purchased or merge with other companies? All that investor money stays locked up. Remember when we talked about liquidity just a few minutes ago? That illiquidity means that those investors can't get their money back out and then reinvest it in new investments. Those unicorns and near unicorns have individual investor money, venture fund investment, and possibly institutional money from pension plans, endowments, etc. If all those investors can't get their capital returned, they can't reinvest it, even if they wanted to. And that limits the total investment capital for every stage of startup. You can kind of think of it as the venture butterfly effect. I'm going to take a quick minute to ask, if you like this content, consider smashing that subscription button. I think that's how the kids put it. I think I'm too old for this. Anyway, in essence, all of this boils down to investor liquidity. It's how we kind of started the conversation. The market needs more liquidity so it can get those investors to participate in future investments and venture funds. Without that reinvestment, funds get smaller, funds go away, and there's less investment capital available, or it gets further consolidated into fewer and fewer funds that you as an early stage founder probably don't have access to and will never get a meeting with. That means startups have to figure out how to go longer between fundraising rounds, operate more efficiently, take a more incremental approach to growth, and be conservative with their spend. Possibly all of the above. If you're a fan of this podcast, you'll hear me say this a lot. This is just more data to prove you have to be very capitally efficient, and you have to be very logical and very thoughtful about how you're going to sustain and grow your business, while venture capital is difficult, to say the least, to raise for most people right now. The NVCA, National Venture Capital Association, believes we're heading into less of a regulatory environment, and that may allow more M&A activity. If the AI bubble turns out to be a bubble, investors and fund managers, we're going to have to look for other things to invest in. That may open up opportunities for people. I'm not so sure how I feel about that yet. I think it's way too early to tell because everything feels like it's consolidating and all the capital for investors feels very locked up right now. At a minimum, investor participation in companies that are AI enabled would be a step in the right direction. So maybe they're not the AI engine. Maybe they're not the LLM. Maybe they are just using some of those as wrappers. Maybe they're using AI as a function of their software, their platform. If we could see some investment more in those companies, that would feel certainly like movement. Most vintners, or people who make wine, will tell you the best, most complex wines come from grapes that struggled. They got a little less water, it was a little too hot, or it was a little too cold. Maybe the soil wasn't as hospitable as it could have been, wasn't conditioned properly, or whatever. Maybe there's smoke taint, which is an actual thing that happens when grapes are exposed to wildfires or other sources of smoke that actually get into the grape and give it a little bit of a smoky flavor. Some people like that. A lot of people don't. But in those harsher conditions, the grapes develop a deeper, richer, more complex flavor, which makes them more desirable. And in their opinion, most people's opinion, a significantly better wine. I once had a vintner tell me that his best vintages came from crops that he almost lost to drought, that they were just on that fine line between struggling and really developing that incredible flavor and complexity and literally dying on the vine. Cool. What does any of that have to do with startups or venture capital? I believe the best companies and the best founders are those that struggled somewhere along the way. Like grapes, harsh circumstances force the founders and their companies to adapt and develop in ways they hadn't imagined. They become deeper thinkers, more strategic, more resourceful, more thoughtful, maybe a little bit more calloused. All of them seem to become better operators when they're working through that struggle. All those things can make them more effective leaders. And the determination they need to succeed despite all the obstacles in front of them better prepares them to utilize resources and funding when those resources are in abundance. So if I know how to operate when I don't have everything I need, I'm certainly going to be much more efficient and much more effective when I do have access to the resources I need. So until venture capital starts behaving more reasonably, take this as your opportunity to struggle, to become better at what you do, more efficient, more strategic. When this asset class turns the corner, you'll be much better prepared than your competitors. Stay hydrated out there. Thanks very much for checking out this episode, and we'll see you next time.